Is big tech on the verge of a massive bubble ready to burst? Or are stocks like Nvidia and the Magnificent Seven the bargain of a lifetime? In this video, we're diving deep into the numbers, the hype, and the risks surrounding Apple, Microsoft, Nvidia, and the rest of the tech giants dominating the market. If you're wondering whether to buy, hold, or sell, stick around. This analysis will give you the clarity you need. Let's start with the stars of the show, the Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla. These tech titans have been driving the stock market to record highs, but their dominance is raising eyebrows. In 2024, they accounted for 63% gains in the S&P 500, and their combined market cap is a staggering $13.1 trillion, larger than the entire stock markets of most countries. But here's the big question. Are these stocks wildly overvalued, like the dot-com bubble of the early 2000s? Or are they fundamentally strong companies poised for even more growth? Today, we'll break down their valuations, growth drivers, and risks, with a special focus on Nvidia, the poster child of the AI boom. Let's dive in. The Magnificent Seven aren't just big, they're colossal. Together, they make up over 30% of the S&P 500's market capitalization, a level of concentration we haven't seen since the dot-com era. In 2024, they delivered a jaw-dropping 63% return, compared to the S&P 500's 21%. Nvidia led the pack with a 171% surge, fueled by insatiable demand for its AI chips. But this dominance isn't just about stock prices. These companies are cash machines. In 2023, they accounted for 75% of the S&P 500's earnings growth. Without them, the index's earnings per share would have actually shrunk. Their profits are so massive that they're compared to entire countries' stock markets. For example, their combined profits last year were half of China's entire equity market. So what's driving this? It's not just hype. AI, cloud computing, and technological innovation are at the core. But with great power comes great scrutiny. Are these stocks too big to fail, or are they setting us up for a crash? Let's zoom in on Nvidia, the undisputed leader of the Magnificent Seven. In 2024, Nvidia's stock soared 171%, and its market cap crossed $3 trillion, making it one of the most valuable companies in the world. Why? Because Nvidia dominates the market for GPUs, chips that power AI, gaming, and supercomputing. In its fiscal first quarter ending April 2025, Nvidia reported $44.1 billion in revenue, blowing past expectations. Demand for its AI accelerators is so high that companies like Meta, Microsoft, and Tesla are building supercomputers around Nvidia's chips. But it's not just AI. Nvidia's chips are critical for the metaverse, autonomous vehicles, and even spatial computing. However, not everyone's convinced this is sustainable. Some analysts argue Nvidia's valuation, trading at over 60 times earnings, is dangerously high. Plus, competition is heating up. AMD and Intel are rolling out their own AI chips, and Chinese startup DeepSeek has rattled investors with a low-cost alternative that claims to match Nvidia's performance. Then there's the regulatory angle. In 2025, the Trump administration banned Nvidia from selling certain AI chips to China, forcing a $5.5 billion write-off. With China being a major market, this could dent Nvidia's growth. So, is Nvidia a bubble waiting to pop, or a company still in its early innings? The term bubble gets thrown around a lot, especially when stocks like Nvidia skyrocket. Let's compare today's market to the dot-com bubble of the late 1990s. Back then, tech stocks like Cisco traded at insane valuations, over 150 times earnings at their peak. Today, the Magnificent Seven's average price-to-earnings ratio is around 43, high but nowhere near dot-com levels. Here's another difference. The dot-com era was fueled by speculative startups like Pets.com, which had no profits or clear business models. The Magnificent Seven, on the other hand, are established giants with strong fundamentals. For example, Meta and Amazon are showing robust earnings growth, and Microsoft's cloud and AI investments are paying off. Bank of America's Michael Hartnett calls this a baby bubble, pointing to similarities like technological hype and high valuations. But others, like Ray Dalio and JP Morgan's Jamie Dimon, argue there's no bubble because AI's transformative potential justifies these prices. McKinsey estimates AI could add $4 trillion annually to corporate profits, and the Magnificent Seven are leading the charge. Still, risks remain. High valuations make these stocks vulnerable to rising interest rates. Hartnett suggests real interest rates hitting 2.5% to 3% could trigger a sell-off. Plus, the concentration risk is real. 30% of the S&P 500's value hinges on just 7 companies. If they stumble, the broader market could take a hit. Let's talk numbers. Are the Magnificent Seven overpriced, or are they a steal? The S&P 500 currently trades at 28 times forward earnings, a level only exceeded during the dot-com era. Excluding the Magnificent Seven, that drops to 24, still not cheap. The Magnificent Seven's average PE is 43, almost double the rest of the S&P 500. But not all 7 are equal. Alphabet, for example, is considered undervalued with a 4-star rating from analysts, while Nvidia, Apple, and Meta are seen as overvalued. Tesla's a wild card. Its earnings dropped 40% in Q4 2023, and its stock has slid 47% since early 2025, partly due to backlash against Elon Musk's political involvement. Valuations matter. If earnings growth slows, as some predict for 2025, with the Magnificent Seven's share of S&P 500 earnings growth expected to drop to 33%, investors could get nervous. So what could derail the Magnificent Seven? Let's break down the risks. First, AI spending concerns. These companies are pouring billions into AI infrastructure, but will it pay off? Goldman Sachs and Sequoia Capital have questioned whether the $1 trillion in AI investments will yield returns. Microsoft recently scrapped some data center leases, sparking a sell-off, and Tesla's 25% drop in early 2025 reflects doubts about its AI strategy. Second, regulatory pressures. The Trump administration has intensified scrutiny on big tech. Antitrust lawsuits against Meta, Google, Apple, and Amazon could lead to fines or even breakups. Nvidia's China ban is already hurting its bottom line. Third, macro risks. Trade wars and tariffs are a big threat. Trump's reciprocal tariffs could disrupt supply chains, especially for Apple and Nvidia, which rely heavily on China. Rising interest rates could also squeeze valuations, as higher rates make growth stocks less attractive. Finally, market concentration. With the Magnificent Seven making up 30% of the S&P 500, any coordinated sell-off could drag down the broader market. Goldman Sachs predicts the group will outperform the rest of the S&P 500 by just 7 percentage points in 2025, the narrowest margin in years. So, are the Magnificent Seven a bubble or a bargain? The truth likely lies in between. If you're bullish, focus on stocks with reasonable valuations, like Alphabet, and consider dollar-cost averaging to mitigate volatility. If you're bearish, look at diversifying into other sectors like small-cap stocks or blue-chip names like Exxon or Pepsi, which are rated as undervalued. For Nvidia specifically, its first-mover advantage in AI is undeniable, but keep an eye on competitors like AMD and DeepSeek. Regulatory risks and China exposure are also worth monitoring. Ultimately, don't bet the farm on any single stock or sector. Diversification is key, especially with the S&P 500 so top-heavy. Stay informed, watch earnings reports, and be ready to pivot if macro conditions shift. The Magnificent Seven and Nvidia are at the heart of a transformative era in tech. AI, cloud computing, and innovation are driving unprecedented growth, but high valuations, regulatory risks, and market concentration can't be ignored. Whether you see a bubble or a bargain, one thing's clear: these companies will shape the future, for better or worse.